Hey everyone, and welcome. Today, we are diving into a huge financial decision that millions of people face, often under a ton of pressure: bank mortgage insurance. You're making the biggest purchase of your life. The bank offers what seems like a simple way to protect it. But is it the right way? Let's dig in. So, picture it. You're at the bank, right? There's just this mountain of paperwork in front of you for your new home. You're excited, maybe a little overwhelmed, and the loan officer just kind of points to a box on the screen. Just click here for mortgage insurance and boom, your family's protected. It feels so easy, so convenient, but is that one little click really in your best interest? All right, let's get right into it. The first thing we need to talk about is the money. What are you paying and what are you actually getting for it? Because when you look at bank mortgage insurance, a pretty clear and honestly not so great pattern starts to show up. Okay, so how much more are we talking about? Well, a report from PolicyMe found that it can be up to, get this, 300% more expensive than a comparable individual policy. No, that's not a typo. 300%. You're paying a massive premium, and a lot of that is simply for the convenience of signing up right there at the bank. That this might be the single biggest, scariest risk of all. It's something called post-claim underwriting. See, with a normal individual policy, they check out your medical history before they approve you. With the bank's insurance, they often do the real digging after you're gone and your family has made a claim. As the Financial Consumer Agency of Canada warns, any forgotten detail from your medical past could be grounds for denial, right when your loved ones are at their most vulnerable. And this right here just perfectly shows the value problem. It's a trap. With the bank's insurance, every single month you make a mortgage payment, your mortgage goes down, right? So the amount the insurance would pay out also goes down. The benefit shrinks. But your premium, the money you're paying them every month, oh, that stays exactly the same. You are literally paying the same price for a benefit that is worth less and less with every payment you make. It just doesn't make sense. So, okay, the money is a big deal. But there's another massive issue here, and it's all about control. Or really the lack of it. When you get insurance from the bank, you might be paying for it. But here's the kicker. You don't actually own it. The bank does. This is so important. Who actually gets the money if something happens? With bank mortgage insurance, the beneficiary is the bank, period. The money goes straight to them, pays off the loan, and that's it. With an individual policy, the beneficiary is your family, your loved ones. They get the money, and they get to choose what to do with it. Maybe paying off the whole mortgage right away isn't the best idea. Maybe they need that cash for childcare or to pay off other high-interest debts. The bank's policy takes that choice completely away from them. And then there's this little trap that catches so many people. Your insurance is tied to that specific mortgage, not to you. So when your mortgage term is up in 5 years and you find a much better interest rate at another bank, you lose your insurance. It's gone. You have to start all over, reapplying when you're older and potentially less healthy, which almost always means paying a higher price. Now, if you get a joint policy with your partner from the bank, it's almost always what's called a first-to-die policy. Sounds grim, right? Well, it is. It means the policy pays out when the first person passes away, and then the policy is finished. This leaves the surviving partner with no life insurance coverage from that policy, just as they're facing life on their own. Okay, let's peel back one more layer here. Let's talk about the risks that aren't so obvious. The things that are kind of buried in the process and the fine print, but can have huge consequences down the road. This quote from the Globe and Mail really hits on a critical danger. Because you have to re-qualify for insurance every time you renew your mortgage, what happens if your health changes? If you develop an illness, you could suddenly become uninsurable, losing your coverage right when you know you need it most. An individual policy, on the other hand, locks in your insurability for the entire term. And you have to think about who's selling you this product. It's not a licensed insurance professional whose job is to find the best product for you. It's a bank employee who, as reporting in the Globe and Mail has shown, is often under pressure to meet sales targets. Their goal is to sell you the bank's product, not necessarily the right one for your family's needs. And man, the fine print is full of potential landmines. The definitions for what constitutes a pre-existing condition can be incredibly strict. There are often limitations for certain activities, and coverage frequently ends at a set age, like 75. When you combine these exclusions with that risky post-claim underwriting we talked about, the chances of a denied claim are significantly higher. So, we've seen the evidence: high costs, a total lack of control, and serious hidden risks. That one-click convenience clearly comes at a steep price. So what's the smarter choice? This chart really just lays it all out, plain and simple, on every single key feature: cost, who gets the money, whether the coverage shrinks, whether you can take it with you, and the safety of the underwriting process. Individual term insurance comes out way ahead. It provides more value, more control, and far more security than the bank's offering. It's not even a close contest. So the verdict is pretty clear. For most people, the superior alternative is an individual term life insurance policy. It's properly underwritten upfront so you have peace of mind, it's portable so it moves with you, the benefit never decreases, and most importantly, it protects your family's future by giving them control. And that leaves us with one final question. That one-click convenience the bank offers is tempting, especially during a stressful time like buying a home. But based on everything we've seen, you have to ask yourself, is a moment of convenience today worth risking your family's financial security tomorrow?